Hi, everybody. Thanks for joining me for a quick update of the interest rate world and all the different safe investing choices. There's a lot going on, so I felt I needed to send this out as quick as possible. The first thing that I need to talk to you about is interest rates and what's going on with them. It seems the market is pushing back on the Fed's raising interest rates. After their last increase on June 16th, the market-based interest rates are really pushing downward. So even if the Feds push it up one more time, we will continue to see the market pushing back against the Feds. And that's usually a sign that interest rates aren't going to stay up very long, and we can't really continue to push up too much further. We're also seeing the inversion of interest rates, which is mind-boggling in most respects. A 10-year treasury is at 2.82, whereas a 2-year treasury is at 2.83%. Okay, so this really causes us to take a close look at the safe investing that we're doing and making sure that we're picking the right and safe investments going forward. And I think this presents quite an opportunity. And those of you that have followed me for a long time understand that I'm not a huge advocate of bonds, and a lot of it was because we had zero interest rates. But seeing how the market reacts to this quick rise in interest rates, individual bonds are certainly an option for people that don't need their money. They just want some safe money that they're not going to have to access. Okay, so this is not good for, say, IRA money with required distributions or anything like that, but it's certainly an opportunity to get locked into some higher interest rates. Maybe if you have some trust money that you want some income to come off of or things like that. We haven't seen interest rates like this since 2013 on individual bonds. And again, keep in mind, don't touch those bond funds, because if interest rates continue pulling back and pushing back on the Feds, we're going to start running into value changes on those mutual funds. So please be careful about buying the mutual funds. We don't have maturity dates to fall back on. If interest rates continue upward and continue pushing against the market, you do lose value in those bond mutual funds. Whereas owning an individual bond, you could sit and wait till the maturity date, get all your money back. So very fast change in our markets. Those 30-year bonds, if you're buying 30-year bonds, these are the yields you're looking at. Yield to maturity of over 4%. And if you go triple B, which again, keep in mind, that's teetering on junk bond status, you're looking at 6% range, all the way down to that 10 years window that you're looking at there. So what I traditionally would call safe investing, AA, AAA, I'm always going to consider those reasonably safe investments when properly used. And I say that properly used. If you're forced to sell these things because you need money, well, then you're not properly using individual bonds. So the yields are much better out there right now. Because I see the market pushing back on the Feds, I think if there's another little window of interest rates rising, we'll continue to see that pushback. But there's a reasonable belief with inversion of interest rates and the market pushing back that it's going to be hard to raise interest rates, because the Feds really control the shortest of short-term interest rates. They don't control the market. They can try to influence the market, and there's lots of economic games they can play. But the reality is that the market is pushing back. It's too hard for our market to bear these higher interest rates. There's so many parts of our economy that struggle at higher interest rates. So please understand, this might be a buying opportunity if you need some safe investments or you need to realign. Bonds are not a terrible idea right now. Especially if you can buy and hold. That's the idea of owning individual bonds. The great thing about bond mutual funds was their liquidity. Individual bonds are not great at liquidity. Okay, and buying bond mutual funds is a big no-no. That's not a safe investment in our market the way it is right now. So the other options out there in terms of safe investments, we have fixed interest rates, much better than the CD market out there. Fixed annuities or multi-year guarantee annuities. The shorter terms are out there, and a lot of it is because the yield curve is very flat, if not inverted. So what typically is 5, 7, and 10 years, we now see some 2-year options out there, but the 3-year options, look at this. 4% fixed interest rate on a 3-year investment. No risk. Most of these companies are going to give you 10% access. It's tax-deferred daily compounding interest. These are always better than CDs. That's the issue I typically see is anybody that owns CDs, these things are always going to beat them. Okay, these are CDs with insurance companies. We don't need to be afraid of them. There are truly no fees in these, and they're always going to have higher rates than CDs. They're going to have provisions so you can access this money, and you're going to get that tax-deferred compound interest. So you're seeing 4%, whether you do 3 years or 10 years. You're seeing some great interest rates here as well. And for those of you that want some more flexibility in their safe investments, the fixed indexed strategies out there are amazing. They're going through a regeneration because a lot of the safe investing world is moving towards the fixed indexed annuity world. So understand, in the fixed indexed annuity, you get to change how you earn interest every year, and that gives you that flexibility. Think about the market that we're in right now, the gloom and doom that we're in. We may feel like we just want to sit back on a fixed interest rate. Well, we can move our money into a fixed interest rate. And in this case, this is 3.5%, and it's guaranteed for all 5 years. That's pretty fantastic when it's really a 1-year choice, because next year we can choose indexing. And this company gives us 3 different stock indices. The S&P has a multi-asset index. Fidelity has a similar index. And then BlackRock has that socially responsible index. So we got 3 diversified indices here, and they give us more than 100% of their performance. That's the crazy thing about these fixed indexed annuities. The way they're able to hedge and protect themselves, the insurance companies, allows them to pay you more than owning the Fidelity multi-factor mutual fund or the BlackRock ESG mutual fund. You're going to do better in this, and you're going to have none of the risk, because all they're doing is buying options on the backside of it and locking this into some decent fixed rates for themselves. So they protect themselves from when they had to pay you double digits, and it's very regular. And the BlackRock index didn't exist in these early years. So, right now my sample allocation is 30% in the S&P, 30% in the Fidelity, and 40% in the BlackRock index. Okay. And again, we can change how we earn interest every year. Okay. The cool thing about this particular safe investment out there is you have no risk to principal at all. You have no fees at all. And when you look at this, you have access to 10% of this account annually. And after 5 years, you have 100% access. You look at the returns on this. The last 20 years, we've averaged over 7% compound. But if you're comparing it to CDs or bonds, you'd have to earn 14% a year to keep up with this thing. And that's a 20-year average. And I'm averaging in zeros here with 40% of the money. So that's pretty fantastic history on these stock indices. You look at the ability to earn more than 100% on these stock indices, and you're averaging fantastic returns. But you have the flexibility to move over to a fixed interest rate if you want to. You get 100% access if you go into long-term care, 100% access if you pass away, goes to your heirs, so they get the money. And again, it's only 5 years. You have access to 100% of this money after 5 years. So in terms of flexibility in safe investment choices out there, being able to access 10% of your money while being able to change from a stock index strategy or a fixed strategy, it seems to be a pretty darn good way to allocate the safe side of your portfolio. So again, this world of safe investing, some people need it, some people don't. If you need your money and you're pulling out your money, you definitely need safe investments. But the rest of you that don't need safe investments, maybe you want safe investments. So individual bonds right now, if you can just live off the interest that they kick out, you have a little window of opportunity to buy some halfway decent yielding bonds right now. The fixed rates from the CDs from insurance companies are pretty great right now. We haven't seen them that high in quite a while. And then the fixed index, the unique part about this one is it's only 5 years and you're locked in terms of they can't change these interest rates and participation rates for the 5 years. And that's unheard of in the indexed world. So just wanted to make sure everybody had a quick update. I felt it was important with interest rates pushing back against the Feds. This might be a short window, and I think we need to reassess our portfolio and make sure that we run out there and get the safe investments we need for the next 5 years or so. Because I think we're going to see a lot of turbulence, not only in the market, but in the interest rate market as well. This happens every time we try to push interest rates up, the market fights back and it creates more and more turbulence. So if interest rates go down, we definitely want our stock portfolio in growth mode, because if they push interest rates down, our stock market tends to respond in kind. So hope all is well. Let us know if we can help in any way. I appreciate you viewing this and hope to hear from you. Thanks again.